What is spread betting? Spread betting is a tax-free, cost-effective alternative to traditional share trading. It allows you to speculate on the movement of stocks, indices, and foreign exchange without using a stockbroker. Therefore, you do not have to pay a commission or fees. Spread betting providers make a spread around the live underlying market price, and you can bet on whether this market will rise or fall. Betting on the movement of a market direction allows investors the opportunity to generate substantial profits on both rising and falling markets. Here's a spread betting example. Spread betting is most easily explained through an example. The concept is the same whatever the market. Imagine that in early August, you believe that the FTSE 100 index's value of around 6,230 was too high and the stock price, or rather stock prices, are due for a tumble over the following month or so. Accordingly, you check your trading platform for a quote, whereas your spread betting provider gave you a FTSE 100 price quote for the third week of September of 6,165 to 6,175. Based on that spread, you have two choices. 1. You could have bet on the FTSE falling below this level by selling the index, or 2. You could have bet that it would be higher than this in September by buying the index. Now, either way, you bet by staking a sum, let's say £10 per point. As you expected the FTSE to fall, you took the former option. Now imagine that on the 17th of September, the FTSE 100 actually rose to 6020, 145 points below the City Index spread. On that basis, your profit would be 1,450, which is 145 times your £10 stake. In fact, you do not have to wait until the 17th of September to book your profits. You can always close a trade early or place a limit order. Spread traders can also close their bets as soon as they become profitable. If the index had stood at, say, 6050 on 1st of September, you could have closed your bet by reversing it. Here are the risks. Now, there is a downside of spread betting, and that is the potential for large gains is equal by the large losses. Now, let's go back to the earlier example. Imagine that you had bought rather than sold in that example. Your loss would have been a nasty £1,550, 10 times, or rather £10 times the 155 points the FTSE finished below your opening spread. It is important for you to note that in spread betting, gains and losses are geared. You are effectively trading on margin, and the more right you get a bet, the more you win. But the more you are wrong, the greater your losses. So it's very important to understand this, and you should only bet with money that you can afford to lose. For more information, visit www.spread-betting.ie.